Hello, my name is Gabby, and my group members include myself, Bobby, Lynette, Amber, and Danielle. Today in this presentation, our group will be discussing different investment strategies. To specify, we will be delving into where, how, and what to invest in. Danielle will be presenting on the different avenues individuals can take to invest. Historically, investors have and continue to make investment decisions via brokerages. However, the advanced technology of today has allowed investors the autonomy of investing for themselves through an application on their mobile device. Additionally, Danielle will discuss the advantages and disadvantages associated with each form. Following this, our group will analyze a few different investment options available. Amber, Bobby, and Lynette will share our findings on exchange-traded funds, mutual funds, and cryptocurrency, respectively. Our group will examine various details regarding the investments. These details include what the investment is, how to find the right investment for your needs, and where to purchase the investment. So why are there different investment strategies? An individual's investment strategy varies depending on their knowledge regarding investing, how risk averse they are, and their investment goal. An individual with limited knowledge would utilize brokerage services where they can obtain professional guidance and advice on their investment decisions. Contrastingly, someone with a broader knowledge on the subject would most likely use their mobile phone application to make investments. The amount of risk the individual is willing to take also plays a significant role when determining investment strategies. Different investments have different risk level, but the individual's investment choices are limited to the acceptable risk level that they have determined for themselves. As an investor gains more experience, their risk level generally rises. For example, if an individual is a first-time investor, it probably would not be recommended to invest in cryptocurrency, as discussed later by Lynette. The final consideration when determining an investment strategy is the long-term investment goal. What does the individual want to get out of their investments? Depending on their end goal, there are specific forms of investments that can aid them in achieving it. All of these factors are used to determine the appropriate investment strategy for the individual.
The question we have decided as a group is, what are the 5 apps used while investing in cryptocurrency?
Hi class, my name is Danielle and today I will discuss various investing platforms. Individuals who wish to start investing often wonder where they should start. The use of technology has made investing easier than ever before. There are numerous platforms which are easy enough for beginners and experienced investors to use. Although investors can still buy and sell securities through banking services such as the Royal Bank and TD, the newer investing apps offer more advantages and convenience to users. I will discuss investing through banks such as RBC and TD, but I'll also talk about the newer apps, such as Questrade and Wealthsimple. It is important for new investors to consider their investing goals and preferences when deciding which platform is best for them. Investing through banking services is a common way many people would think to start investing. People usually choose this because banks have a lot of different choices for securities, and you can also work with financial advisors to gain advice. Additionally, many investing services are available online. The Royal Bank's direct investing offers great investing options. Clients of RBC are able to have practice investing accounts, which allow potential investors to understand how the stock market works, allowing them to make better investing decisions in the future. RBC has many choices to invest in, such as stocks, ETFs, mutual funds, and options. Trading could be conveniently done online, or clients can work with a representative. Although the services by RBC seem very ideal, the fees and commission can accumulate quickly, therefore decreasing trading profits. By using the online site, most clients who invest in stocks, ETFs, and mutual funds pay a commission at about $9.95 per transaction. However, individuals who have 150 or more transactions per quarter will only pay $6.95 per transaction. Alternatively, if clients choose to make investments with a representative, the commission fees will be higher. The usual commission is $35 per transaction. As for the maintenance fees, clients with less than $15,000 worth of assets will pay $25 per quarter. However, individuals with more than $15,000 worth of assets will be exempt from this fee. I'm going to move on to the TD Bank's Easy Trade account investing. The main securities offered by TD are stocks, ETFs, which are on both Canadian and American stock exchanges, mutual funds, etc. This bank also offers their own TD ETFs, which have their own benefits. A TD Easy Trade account is designed with inexperienced investors in mind and offers resources such as videos in order to give people investing advice and allow them to gain more knowledge. Similarly to RBC, these services can be offered online. As for commission fees, TD allows clients to have 50 commission-free trades per year. Afterwards, they will pay $9.99 per transaction. However, if clients purchase the TD ETFs, that will be a $0 commission fee. There are no maintenance fees if you open a TD Easy Trade account with the US currency. In addition to the no maintenance fees, there will also be no exchange conversion fees under this special account. As we observed, many investing platforms via banks can have high commission fees. Many investing apps that have entered the market recently have developed a way of investing easily with less fees. The first investing app I'm going to talk about is Questrade. This platform mainly focuses on buying and selling securities such as stocks, ETFs, mutual funds. Questrade is highly appealing to users because they are able to trade securities conveniently and anywhere on the mobile app. This app is also very easy to use. It can be overwhelming to keep up with your investments. However, this app notifies you when there's any price changes, and the portfolios are managed by experts in order to minimize risk and balance the portfolio. Therefore, this will help increase returns. The information provided about the stocks is very consistent with the real-time market, and there's no delays. In terms of fees, this app offers no fees on mutual funds, and the management fees are usually about 0.25%. Next, I'll discuss Wealthsimple. This app is also very popular and easy to use. It's actually pretty popular amongst college students. What is particularly interesting about this app is that users can select their desired risk level. There are 3 risk levels, which are conservative, moderate, and high growth. After they selected a risk level, the app creates a customized and diversified portfolio which aligns with the risk level and the investing goal of the users. Experts will observe the changes in the stock market and rebalance the user's portfolio accordingly. Another interesting thing that many dividends that are paid out will be used towards being reinvested. For fees, it depends on which membership you are a part of, and the membership depends on how much money you deposit. A basic membership, which is $0 to $100,000, the management fee will be 0.5%. A black membership, which is over $100,000, is 0.4%, and the generation account, which exceeds $500,000, features no management fees. This app also features 0 commission fees. Although banks are thought to be a more traditional way of investing, the innovative apps, including Questrade and Wealthsimple, allow investing to be more convenient and efficient for experienced and beginning investors.
Hi, my name is Amber, and I will be discussing ETFs. First, we will briefly discuss what ETFs are. ETF stands for Exchange Traded Fund, and they are baskets of investments, and they track different indexes, sectors, and commodities. Some of the popular ETFs are SPY, which tracks the S&P 500, SQQQ, which is a 3 times leverage inverse that tracks the NASDAQ 100, and QQQ, which just tracks the NASDAQ 100, which includes stocks such as Apple, Microsoft, and Amazon. ETFs have a low expense ratio, which means you don't have to pay a lot to invest in the ETF market. They are also highly liquid, which means you are able to sell them relatively quick. They also have a large range of investment choices and different categories to choose from. Lastly, they make it very easy to have a diversified portfolio. ETFs are very ideal for beginner investors because they are more safe than most other types of investments. These 2 pictures show the different types of ETFs, as well as the different sectors that are available. Now we will move on to some different strategies that you can use when investing in the ETF market. We will discuss dollar cost averaging, asset allocation, swing trading, sector rotation, and betting on seasonal trends. The first method is called dollar cost averaging. It is the most basic strategy. This technique works by buying a set amount of investment on a regular schedule, regardless of the price. If you buy high one time and buy low the next, it's okay because it averages out in the end. An advantage to the cost dollar averaging method is that it makes you more disciplined in the saving process. The next strategy is called asset allocation. Asset allocation occurs when you allocate portions of your existing portfolio to a different category, such as bonds, stocks, and commodities. ETFs have a low investment threshold, making them perfect for beginner investors to implement an asset allocation strategy. An example of this could be a young person investing 100% in equity ETFs in their 20s, but then changing their investment strategy as they get older to maybe 60% equity ETFs, and 40% bond ETFs. Next, we will discuss swing trading. Swing trades take advantage of the sizable swings in the stocks, currencies, and commodities markets. This can take place anywhere from a few days to a few weeks. This is not like day trading in the sense that it cannot be taken place in a few hours. It has to take place over a few days or longer. ETFs are suitable for swing trading because of their diversification and tight bid-ask spreads. ETFs are also available in different investment classes, which you can use to your advantage if you have more knowledge in one category over the other. ETFs will not have the same type of swings as the stock market, but this will protect users against the large downswings that can normally be seen in the stock market. Next is sector rotation. This technique works by buying ETFs in one sector, saying the energy sector, and then later moving all of those investments to the technology sector. This move is done to be defensive, and an investor will move their investments to a sector that is overall safer. The last strategy is called betting on seasonal trends. And betting on seasonal trends is a way for investors to capitalize on the seasons. The first phenomenon of betting on seasonal trends is called sell in May, go away. And it refers to the fact that the equities market tends to underperform from May to October and then increase from November to April. Investors could also take advantage of the retail market during holiday seasons by buying ETFs in the retail sector before a major holiday, such as Christmas, and then selling them before the holiday is over. This method takes advantage of seasonal trends and is easier to predict.
My name is Robert Laguerre, and I will be discussing the topic of mutual funds. So first, we will discuss what a mutual fund is. So mutual funds are professionally managed portfolios. They generally consist of equities or fixed income assets, such as bonds or a mixture of both. Each mutual fund has a team of analysts or portfolio managers that design and rebalance a portfolio in order to keep the holdings in line with the mutual fund strategy and risk. Mutual funds are a great way for investors to diversify, since each one holds a basket of assets, similar to an ETF, but we will discuss that later. An important distinguishment from purchasing single securities is when you purchase a mutual fund, you do not own the underlying securities. Rather, you purchase the fund itself, so you have no voting rights for each security. There are many different types of mutual funds, but to keep it simple, I'll discuss the three main types I found. So the first one being fixed income. This consists mainly of bonds, usually corporate or government, or any other form of debt instruments that provide a fixed payment to the mutual fund. The next is equity. It's pretty self-explanatory. This consists of company stocks. The next would be multi-assets, and that can be a combination of fixed income and equity. Some mutual funds are exploring real estate and private equity holdings and other alternative assets. This is less common than the three main funds I just discussed, but it does seem to be a growing trend. So where to buy? Traditionally, to purchase a mutual fund, one would have to go through a financial advisor. But with the rise of DIY investing and online brokerages such as Questrade and TD Direct Investing, investors can now purchase mutual funds themselves through some of these brokerages. An important note is not all brokerages support purchasing of mutual funds. You just need to check with whoever your broker is to find that out. So how to find the right mutual fund. When considering what mutual fund is right for you, there are three main questions you should be prepared to answer. First of all, what is the investment for? A house, your education, retirement. Next, you consider your time horizon. Are you saving for retirement in 20 years, 5 years, 10 years? And lastly, you want to consider your risk tolerance. So how much volatility can you handle? The first two questions kind of help answer this one, but it's important to have your own idea of how much risk you can take. So let's say you're saving for retirement in 20 years and have a moderate level of risk tolerance. An equity fund with higher risk and therefore higher growth potential may be a good choice. So let's take that same situation, but change the time horizon to 5 years. Now you'd want to consider a lower risk mutual fund, maybe one with a larger amount of fixed income. So here we will actually cover a mutual fund on Sun Life Financial's website that caters towards a low risk situation. So each mutual fund will have a profile consisting of very similar things as what you see right now. However, this is not extensive coverage of the fund, rather a brief overview of what to expect when shopping for a mutual fund. So on each profile, you'll find the management expense ratio under the fund essentials, management fee, again, under the fund essentials, portfolio composition, that middle picture there. As you can see, it has a fixed income. This portfolio has 57.6% fixed income. And then on the left there, you'll see the fund profile and an option to open a PDF, which explores the mutual fund in greater depth. So some more about the mutual fund. On the left, you'll see the risk profile. Again, this had mostly fixed income, so it is very low risk. In the middle, it discusses the top 10 holdings. At the top, you see a bond fund. And then on the right, you'll see the management team. So just a brief discussion about mutual funds and ETFs before I pass it off to Amber to cover ETFs. But these two get confused quite often, and very reasonably so. But a couple things to know. So mutual funds generally have a higher fee. That factors in the advisory services and active fund management. Mutual funds are also generally for investors with long time horizons, so 5 years plus, and people with low involvement. People that don't want to be constantly rebalancing their portfolio or worrying about really worrying about their investments. So mutual funds are generally purchased through a mutual fund company or somebody licensed under the MFDA, generally through an advisement. With ETFs, they have lower fees, generally active investors that are willing to be a bit more hands-on with their portfolio. And ETFs generally can be purchased through a brokerage account by the investor themselves. So what to choose? Well, I mean, that was only a brief comparison between the two. I'll be passing it on to Amber to discuss in greater detail what an ETF is, and you can make that decision for yourself.
What are cryptocurrencies? Cryptocurrency is a generational opportunity for future wealth. It's also referred to as crypto, but it's a decentralized digital currency that is based on the blockchain technology. It uses cryptography to secure transactions. And the name crypto comes from the process of encryption to verify transactions with the involvement of advanced coding. The first cryptocurrency was Bitcoin, founded in 2009, and Satoshi Nakamoto is the creator of Bitcoin, yet his identity is unknown. So why invest in cryptocurrencies? Adding crypto to your investment portfolio is a way to diversify. It is in a very different industry, but has the potential to maximize your portfolio's growth. They operate under a fixed supply, which means no printing of money and a lower inflation risk. With minimal government control over cryptocurrencies, there's less corruption, avoiding of a crisis, and protecting a country's currency from suffering. By being an early adopter, investing in new technologies can impose important future applications towards cryptocurrencies. In comparison, with Bitcoin being gold and Ethereum like silver, Bitcoin is the OG and Ethereum is like silver compared to Bitcoin in terms of store value. Ripple is actually currently under investigation by the SEC for selling as a security. It is an example of looming regulation. And Tether is super important due to its ability to stay in the range of $1 US. CoinGecko is one of the most popular websites to see the value of each crypto coin. And these are the types of, here's a snapshot of the coins listed on CoinGecko. So obviously you'll see Bitcoin and Ethereum at the top as they are the most popular, and Tether. And then you might be familiar with the names Cardano, Litecoin, VeChain, Dogecoin, those kind of coins will be on there as well. Apps to use for cryptocurrency investing. These are the most used apps in Canada. Wealthsimple and ShakePay have lower fees, and Wealthsimple has been continuously adding new coins. It is also one of the best apps for students to use, and CoinGecko shows all of the coins listed. If you're looking for one, it probably has it. Binance is probably the most known worldwide. Short-term trading strategies for cryptocurrency. They are in a highly volatile market. There must be a balance of trade-off between risk and return. So day trading is one form of aggressive short-term trading. The market is open 24/7, so it has the flexibility to fit your schedule. Unlike the stock markets are only open for a certain amount of time and in whatever era they are in. Some strategy things to note: set a time that you'd like to trade every day. Always start off with a small amount. Don't be too risky in the beginning, just to get a feel for it. And you could also use brokers who facilitate price speculation to enhance the security of your investments. Identify a trend using technical analysis. Always wait for a pullback. Buy at the pullback on an uptrend market. And always sell at a resistance to take a profit. Exercise all your resources when it comes to learning about technical analysis. Watch YouTube, buy books, join courses for strategies about investing specifically for cryptocurrency. Another way is deciphering charts by studying them in all time frames. 1 hour, 24 hours, 1 month, 3 months, 1 year, more than 1 year. It'll only educate yourself more about market trends. And now long-term investing strategies for cryptocurrency. So similar to stocks, but have a plan based on your risk tolerance and financial goals to be profitable long-term. Couple things you might hear are hold on for dear life. And then this is a reference to volatility. So it's a strategy that can provide safety for investors so they are not exposed to short-term volatility, which can avoid the risk of buying high and selling low. And you'll also hear dollar cost averaging, where you can invest regularly at smaller intervals when you are buying during the dip. This can lower your entry point if you had purchased near the top, but as it's on a downward trend, you keep buying just so that your higher point isn't so high anymore. Consider using limit and stop loss orders, as market orders can involve a little bit more risk due to high volatility within seconds.
And again, the question that we asked as a group is, what are the 5 apps used while investing in cryptocurrency?
There are various investment strategies an individual can choose from, depending on their knowledge, level of risk they want to take, and their investment goal. An individual can choose to invest through a bank, such as RBC and TD, or a mobile phone application, such as Questrade and Wealthsimple. An individual can also choose what they want to invest in. One option is a mutual fund. A mutual fund is a diverse portfolio of investments where you own shares of the mutual fund. This option is good for long-term investments with minimal involvement required. Another option is an exchange-traded fund. This investment is good for beginners because it easily allows the individual to diversify their portfolio with lower fees than mutual funds. The final investment option discussed is cryptocurrency. Investing in cryptocurrency allows an individual to diversify their portfolio into a different industry. This type of investing is more complex as compared to mutual funds and ETFs. Therefore, this investment option is more appealing to experienced investors. If you are looking to start investing, be sure to carefully plan out your investment strategy.